Recording in progress.
Okay, so last session we treated the type of market that we have as far as Forex is concerned. You know, we treated uh,
There's something else, day traders, and right?
the type of traders we are talking about.
Yes.
Yeah, we did mention the type of traders. We have intraday trader. There are those people that open their trades and ensures that their trades, they will close it before the close of business day. But if there's any need for them to, like if the momentum is strong, you understand, maybe you are in profit and you now discover that, okay, the momentum is very strong and from the higher time frame, they are pushing to a particular resistance level or a support level. Once you are able to figure that out, you can take partial profit and hold your position overnight if there is need for you to do that. So intraday traders, they do that as well. But majorly, what intraday traders do, they open their trade during business day and ensure they close their trade before the close of business day. And you know, when you leave your trade open to run overnight, there's extra additional cost, you know, to it. Like we have what we call swap. You understand? So is a cost for holding a trade overnight. All right. So, and it now depends on the currency pairs that you are trading. And so, that is intraday trader. Then there's one we did not mention last time. That is scalpers. All right. Scalpers, they don't hold trades. All right. They just capitalize on trend. They enter. Once they enter like this, 5, 10 minutes, they are out. That
I
is
mean,
what.
they don't spend time in the market.
Sorry?
That means they don't spend time in the market.
They spend time,
Oh,
but they don't spend time on a particular trade. All right?
okay.
They trade all day. But that one is very, very, you have to, as in, you have to be, it's not something that you just set your limit orders and go. They are physically present watching their system. All right? Once they see any opportunity, they enter. As soon as they enter, they catch like 10, 15 pips, they are out. All right? They are out. They just close the trade. They enter, close the trade. Enter as the trade moves into in their favor, they catch some pips and they close their trade. So they don't stay long, like 1 hour, 30 minutes, no. Some minutes. Once there is volume in the market, they are able to identify that they enter, capture some pips, and they close their trade. They will now wait for another opportunity. So those people, they make so much money and also they lose so much money too because they overtrade. You
Okay,
understand? They
I
overtrade.
have a question concerning this thing now. Because some don't know how to even put the question, so because I usually see like some trades or they buy after maybe 5 p.m., 6 p.m., and then they are.
Do you know that I barely hear you?
Can you hear me? Can you hear me?
Yes, I can hear you now.
Probably it's the network. I was asking about this PIP. Does it really matter the numbers of pips that that goes by before initiating a trade or buying? Because I see some they sell probably after 6 pips, some 5 pips, and all that. Does it really matter the number of pips?
If I understand you correctly, you are asking if it matters how many number of pips you can that the trend or a particular candles will print before you enter the trade or
Yes, yes, yes,
okay, wait. You see, can you see my screen?
yes. You can see it.
Okay. Right now, this is where what I yesterday, this is what I traded yesterday. You understand? You see
Okay.
this mark here?
Mm-hmm.
Okay. So when I saw this, when I woke up in the morning, I saw this thing here, like this. I just know that the trend is going to go bullish. All right. So what I did was to mark this thing. And once there's a breakout, I will also wait until it comes back to retest this level. Some will retest this, they will get to this point, then before they push to the upside. All right? Like this one now, this thing is what? A falling wedge. All right?
Okay.
This is a falling wedge, and that signals a uh, a bullish push. So what I did was to wait for price to break out first, then come back to retest it. And what did price did? It pushed below. The essence of this is to take liquidity. It pushed below to take liquidity. After he has done that, I saw the push. I saw the volume. Immediately, this candle closed. This very candle here closed and now entered. You see what price now did? It pushed again down, all right, before it now rejected and started pushing up. This morning again, you have seen this formation again, right?
Coming down.
You can see this formation now. So I've already plotted all those lines. Then I'm waiting for it to break out, then come back before it push to the upside. So now the question is, how many pips will it get to before you enter? Is that not your question?
Yes.
Okay. You don't use that to time your entry. Oh, yeah,
Okay.
you don't use pips to time your entry. All right. So what you use to time your entry is a candlestick. If it's going to go bullish, let's say, for example, now this very one that is here now, all right, this time frame is 1 hour, 1 hour time frame. You can see now this candle is been printing, all right. I will have to wait. If I want to enter, I will have to wait for this candle to close. Once this candle close, the next candle, if it opens up from here, all right, if it opens here, that means bullish candle opens from the down, all right, close from the
And
top.
up.
then the bearish candle will open from the top, close from the downside. So now, once this candle close and another one now open here, this place I put this line here. Once it open and I see that it's pushing to the upside, I can now enter. All right. Then I know, okay, and I will now know, and I will still watch the candle very well to know if there is volume. Because if the price is not accepted yet, even though it has broken out of this channel, sellers will reject it. That means it will have to come back. The thing will come back, reverse, and come back. So in trading, you need to have patience. That is what most people are lacking. They rush. Like seeing this bullish candle here that has engulfed this bearish candle, some people would have entered. Now you see what is going on here now. Something that has already pushed to the upside is now coming back again and is dragging. All right, there is no volume yet. Now, somebody that has already entered now will now be praying, oh, this thing should go, it should go up, it should go up. And the person will be worried. Emotionally, you will be troubled. Because why? You have already entered. That person, a trader like that, has just entered too early. That is not how to trade. You have to wait for, we are just treating this one, but once we get to structure properly, then I will start teaching you all these things in detail. You have to wait for price to break out of this channel. And once price breaks out of this channel, if it breaks out from this channel, it's going to come back. You have to wait. It's going to come back. Once it comes back, then you now see price, price going up again. Once it come back to retest the channel, immediately it gets here and you see a rejection. Some will come down to push people out. People that have already entered early. The price will come back, push people out. Because normally, once you enter from here now, your stop loss, you put it below the structure here. Price will come back here to stop them out, to push them out before you now start going up. So when you see this kind of formation, you wait for price to break out of this channel and let price also come back to revisit the channel before you now enter. And once you enter, you will see volume. Price in the next 10 minutes, you see the thing will don't fly.
We now have to move higher.
Huh?
It will now have to increase again.
It will not have what?
So increase, just think about before that, after in the next 10 minutes, the price will now move higher.
Yes,
again.
the price will now start going up because the demand. Once there is demand, the price will go higher. You understand? So it's like that. So you use candlesticks to time your entry, not pips. All right?
Okay.
Like scalpers that brought that question, scalpers will just, once they have entered, once they are able to catch like 10, 15 pips or 5 pips safe, they will just close their trade. They are okay. They will now wait for another opportunity again. That is scalper. I hope that is clear.
Yes, yes.
Then we talked about uh, intraday trader, then the scalpers. Then we have swing traders. The swing traders opens trades. They can hold trade for days, weeks. All right. So those ones, they capitalize on a long trend. All right, they stay on the trade for a very long time, no matter the fluctuation. All right, because price will go up, come down, go up, come down. Just like, for example, if a swing trader opens a position here, because if you look at this whole thing here, if you look at this whole thing here, everything started here, this point. So a swing trader will open a position from here. All right. Then they will stay till they have their target. Maybe their target is here until price gets here before they close here. Before that is where they put their TP. That is a take profit. Can you still remember what take profit order is all about?
Yes.
What is that take profit order? Don't look at
It's
your
when
notes.
I don't even have the note set. I don't even know where I keep that note I jot with. That's what I was looking for.
How can
I
you
think
not
to
have the note again?
where I keep
You have
the
to be organized, otherwise you
I
pay
will.
fine.
I will.
So
Just
can
hold
you
on.
just give me a summary of what take profit order does?
I think when it gets to a particular point, instead of moving forward, just take your it will just take it and then close the market for the day, right?
Yeah. Okay. So that is it. Take profit order helps you to secure your profit. That is, you have entered the market, and the thing is going in your favor. You are making profit. So you set a take profit order, telling your broker that as soon as price get to this point, it should close your trade. Your trade should close. You are okay with the profit. So take
Point.
profit
That point.
order.
That
Eh?
point. You just put that cursor. Now I think that's the resistance point, right?
Yes,
Mm. Okay.
you can use a resistance level or point to set your take profit order. That is in a bullish market. All right. So in a bearish market, you can use a support level or a support point to set your take profit order. All right. Meaning
Stop
that,
loss.
huh?
What about stop loss?
Stop
The same,
loss, okay.
the same thing
Uh,
applies, just take profit, right?
Now, stop loss, let's say, for example, you enter from here. Your stop loss, this is your entry. Then your stop loss will be below the structure. Do you understand? Your stop loss will be below the structure. Then your take profit will be, you now say, okay, I want to take my profit here. Do you get? So this is where you entered. You use your stop loss to protect your capital. You use your take profit to secure your profits. Do you understand? So let's say now you enter from here after your analysis with the expectation that price will rise, or rather price will go up. All right. Now something now happened. It now started coming back against you, going against you. You have your stop loss here that will protect your capital. As soon as price drops, gets to this level, your stop loss will trigger. Then it will take you out of the market. All right. So that just assume now that there's no stop loss and you are not there to monitor the system, monitor the market. Maybe because of your busy schedule, maybe you go to, you are not at home, you are at work and all that, you have no chance to look at your trade. Then you now started, something happens, you have entered, then you now started going against you. If there is no stop loss, that is how it will drain your capital and finish everything. So stop loss, it's something that is very, very important. You don't, even if you are in a hurry, as soon as you, this is the sequence. Once you place a buy or sell order, the next thing you should do is for you to put your stop loss immediately. Let's say, for example, you did not even set your target. If it's going in your favor, it will continue to go. It will continue to go. Then when you now have time, if you check it and you discover that you've made enough profit, you can click and close it immediately without using a take profit order. You can close it yourself. That is if you have the time. So that is just how it works. So I hope you understand. Are you still there? Are you there? Hello? Can you still hear me? Hello? Well, can you hear me? No, there's no problem. There's no problem. Okay, I will just continue. Once your network is okay, then you let me know. But since you can hear me, it's still okay. Okay, all right. So, okay, there's no problem. Once your network comes back, please do let me know. So that is how we use the stop loss order and the take profit. So for uh, swing traders, they hold position for days, weeks, and all that. So then the last one is the position traders. Position trader, those ones, there's not much to say about that. They hold position for months, even going to a year. So, and we have investors too. So all those ones, they hold position for years and all that. And they don't trade every day. They take position, they allow it to run 6 months, 7 months, 8 months, 1 year, like that. So that is how it is.
Okay. Can you hear me now?
Yes, I can hear you.
Okay. Okay. Yeah,
So
I'm
the
listening.
sideways or a range bond, then price moves when in a sideways or a range bond market, price moves horizontally between support and resistance level. It indicates market indecision or balance between buyers and sellers. Traders may use range trading strategies. Buy low, you sell high within the range. So what does that mean? It simply means that, for example, in a range bond market, it's something like this, all right? Like this. Now, what price does is, let's say if it's coming like this, it was bullish, then you now get to this point, it will just be moving from this point to this point like this, from support to resistance like this. So it will just get stuck inside this range. If you are a smart trader, you will understand that, okay, this is ranging. But most people don't know. They'll just say, oh, they'll just jump in. Before you know it, the price will come back and take them out. They will still jump in again. You don't trade like that. Once you know that the price is in a range, then all you need to do is either you stay away or you enter from the support level. Your target should be here. You understand? You don't need to say, okay, I want to target too far because you want to make more money. Not knowing that as you enter from here, once price gets here, it's going to come back. So if you are still there and the price gets to this point, it takes you out. So once price is in a range bond, it will be moving from one level, from this support to a resistance, come back to support, go to resistance, come back to support, goes back to resistance again. It will just be jumping from here until it breaks below or it breaks above. And once it breaks above, you wait for the price to be accepted. Then once the price is accepted, it will come back to this level. Then before it will now push. It will not start going up. Or you wait for it to break below, all right? Wait for price to be accepted. You come with the price, once the price is accepted, it will come back to revisit this level. Then before it starts going down, that time you will not see volume. All right, so that is range bond market. Once you see that the price is locked up, it's just going sideways, you know that it's a range bond. So the ability to identify it is key. Most people don't know. So this is an example of a sideways or a range bond market. So you see, it enters here like this, it bounces like this, it gets to this point again, support level, a resistance level, just like that, until price will now find its way. Either it breaks above, come back to retest, and it will start going up, or it breaks below, all right? Once it breaks below and the price is accepted, it will come back to retest, then it will now start going down. So that is just a range bond market. Then trend duration. Remember you mentioned this trend duration. We have category. Trends can also be classified by how long they last. All right. You have the trend type, the duration, and example. We have the short term. The short term, that one usually lasts minutes to days, like I've told you before. So you can, once the trend is bullish or bearish, if it has a momentum, it will last for some time, maybe minutes, hours, even a day. All right, it will continue, but that does not mean that it will not. That does not mean that there will not be a pullback in between. This is what I mean by pullback. The trend is going up like this, then it will come back. Once some people see something like this, that Okay, it's blue candle, or whatever candlestick you use to represent your bullish candle. Once they see opposite candle like this printing, oh, their mind will just fly and they will be out of the market. Instead of you to know as a trader that once a trend is bullish, once it creates a structure, there must be a moment of relief, that is a retracement, we can call it retracement, or a pullback. And what does that mean? It means that in trading, in Fibonacci retracement tool, we have what we call Fibonacci retracement tool. We have this, like this line here, this point here, from this point here down. This is a discount point. The upside is what? Is premium point. Then when you now want to measure a retracement, you plot your fib. This is a fib, you plot it. You plot your fib from 100 to 0. I will also teach you how to use Fibonacci to time your pullback before you enter. So that I won't get to technicals, then I will show you. Then from this 100 to 0, all right? Then from here, this 50 here, this 50 here, down is what? Is discount. This is discount. This is discount level. Then from here, this is premium level. From 50 to 0, this is premium level. From 50 down, this is what? Discount level. Now, what I want you to understand is that once price is trading, is going up, once it creates a structure, you wait. As it's pulling back, price will surely pull back to a discount level. Once price touch 50%, it will start coming down. 61%, it start coming down again. 79%. That time, price will not break below 100%. If it does, that means the trend is about to change. So the thing is, from 50% down, this is a discount level. When one price is going up, price is going up like this, then you now get to a resistance. As it's coming down, it should, one moment, because I set a lot and there's a lot I set, so I need to check this and let me know where, okay. Okay.
Alert on Euro USD.
Huh?
I'm seeing the alert.
Is you can see price is coming back to this level now. So before me, I will enter because I'm watching this very well. Before me, I will enter now because I will soon get into this trade. I will trade. Before I will enter, this guy has to finish. We have 22 minutes here. Look at this point. 22 minutes. Yes. Before another candle will appear after 22 minutes. So this guy now is coming now to take liquidity. But if he breaks below this level, if he body breaks, that means the body, if he breaks below, is allowed to pierce it, something like this, with a wick. You know what wick is all about, Sha? Do you understand? When we say wick. So it is allowed to wick below, but it's not allowed to body break this level. Once the body breaks this level, I will have to change my bias immediately. Then I will not be looking for an opportunity to buy. I will have to wait. Let price action tell me what he wants to do next. Because once the body breaks, it might just push a little up, then drop. Then we have started bearish trend. All right. But if he wicks below, then close above this point, that means the next candle that will come out, even if it's bearish candle, I know that that bearish candle is not going to push anywhere. I will still wait for that candle to close until I see a bullish candle. That bullish candle now will now push higher than the last candle. Once it body breaks the last candle, I will just allow it to close. Once it closes, I see another one very bullish candle opens again. I take my position. As simple as that. Once I take my position, with proper risk management, I put my stop loss below, then I set my target this point, because if it start to go up now, it's going to push up to this point. Why? How do we know? If you go to higher time frame, like 4 hours, what is the next support level? This is the highest where price got to. All right, and price is here now. Look at. Price has already traded up to this point yesterday. It has traded up to this point before a retracement. This is a moment of relief. All right. Then he needs to now push again up. Once he start pushing up, once he clears this place, he's going to get here. He's going to get here. And once he gets here, all right, this place is the highest, but this is where price got to. Or if you look at all these candles, their bodies, this is where they close from. All right, this is the highest. Now, but this is the highest where price reached here. All right, so price may likely get to this point or this point here. So if I want to set my target, once I place my entry, my target will be here. Then my stop loss will be below this place. I allow my trade to run. That's all. That's all. Me, I don't like to publicize something, but I will send you now a screenshot of what I made. I made over 1,002 yesterday. I'm telling you. I will send you the screenshot, but I don't like publicizing something. Like as what most people normally do. Yesterday, I just set this thing. I was doing another thing. Before you know, it just hit my target and I was out of the market. So it's like that. You don't rush. You wait for an opportunity. You wait for an opportunity, and once the opportunity presents itself, you just take advantage. That's all. That is what trading is all about. If you rush, you will lose your money, and you will now be complaining. As it is now, the market is not ready, so you don't need to do anything. You don't need to do anything. You don't need to do anything. It's just for you to wait until the market is ready. When it's ready to buy, because he has given us this formation here, it's supposed to go up. Price is supposed to go up. Yes, this is the formation. It's supposed to go up. Now, once this one is done, you will see. It's remaining 17 minutes before we now see the next candlestick. But before that, we need to see a rejection from here, a sharp rejection. Right now, there's no rejection. Price, if it push up to this point, there should be a rejection. Or the next candlestick, once it opens, even if it's a bullish candle, it might push down a little, then gets a rejection, then you now start pushing up. As soon as that candle close bullish, the next candle open bullish, then you enter. As simple as that. So we have the short-term trend, which usually lasts minutes to days. Example is intraday or swing traders. they capitalize on that kind of trend. Or scalper. Scalper, they don't, their own is, they just, their interest is just to catch some pips and they're out. They don't waste time at all. They enter, collect some pips, they're out. They don't care about, okay, they want to set their target TP and all that. No, they don't. They enter 10, 15, 5 pips, they are okay and they're out. So we have the intermediates that will last for weeks to a month. So trends can last for 1 week, can last for a month, or it can last for months rather. Those are for position trades. Those are for position traders, long term, several months to a year. So investors or microeconomic trends. So those ones, as a matter of fact, as a retail trader, you don't have business, stay in a trade for too long. All right. The idea is for you to at least make your daily money. That is, most traders, they are intraday traders. You open your position, monitor it, take your profit, and you are out. Because as far as Forex market is concerned, opportunity will always present itself every now and then. And don't overtrade. Don't overtrade. If you take like 1 or 2 trades in a day, it's okay. Because once you take like 1, 2 trades in a day, you close your system, you forget about it, wait for the next day. Because the more you stay there, the more you will see opportunities and you will be tempted to take a wrong move that will now make you lose your money. And by the time you lose, maybe you take a trade and it hit your stop loss, all right? That hitting your stop loss means you've lost some money. You want to make that money back that day. And as a result, you will now be taking decisions that are not right. And as you are doing that, you are losing more. So even if you take a trade and at the end of the day it goes against you, shut down your system. All right? Because psychologically, anybody that loses money, there's a negative effect. That time, you want to get the money back immediately, which is possible if you are the type that has deal with yourself, that is psychologically sound. All right, you know that, okay, you did something wrong. That was why it hit your stop loss. Okay, you clear your mind, wait for another opportunity, and don't be in a haste to take decision. And once you have gotten to that level, that means you are a professional trader. And at the end of the day, if price hits your stop loss and there is no better opportunity that day, you forget about it. You wait for the next day. So that is just it. So how to identify trend? You identify trend by using a trend lines. You draw along swing highs and swing lows to visualize direction. You can also use moving averages that help smooth out price action and confirm trend. You can also use price action. Look for consistent patterns of highs and lows. All right. All right. So, like we say trend and trend lines. When we say trend lines, we are simply saying, for me to know that this is a bullish trend, I can take this trend line like this, draw it, all right, like this. This is a touch. I was able to get a touch because why? There was a pullback here. Now, there will be another touch here. This thing we just did now, this is a strategy for most traders. They use that as a strategy. Price has touched this place. He has touched this place again. Drag this trend line straight. Then as it's pulling back, they are waiting for price to touch this line. Once it touches this line and once it touches the trend line and if they see rejection, this is their entry. So one way to identify a trend is by what? Using a trend line. As it is, you just know that it's going up. This is an uptrend, a bullish
So
trend.
without a trend line now, you cannot identify it.
Sorry?
I said without a trend line now, you cannot identify it, right?
That is a bullish trend. I didn't get your question.
Can you hear me?
I can hear you now.
Do a trend line. My question is, without that trend line now, you cannot identify it, a trend.
You cannot identify if it's a bullish trend or a bearish trend. Is that what you are asking?
Without that trend line. Drew a trend line just now.
Yes.
My question is, without that trend line, can you, yes, this one we are just doing now. Without this line now, can you still identify where the prices meet at those three circles you drew just now?
Yes. Okay, yeah, I now understand. I did something like this. I did another one like this. I did another one like this, right?
My question is, without this line now, without yes, this line you drew now, that means can you still identify it without that line?
Okay, now I get your point. Without the trend line, yes, I can still identify it because I know that price took off from here. What happens? It broke structure from here. Here we'll say break of structure. It broke structure here. Let me remove all these things so that it will be clear. All right, so it pulled back. When he got here, he created a high, then he made a pullback. Then he now pushed again. When he pushed, what happens? He broke structure again to this point. Then he pushed again. He created a high. It's coming back to this point. What I should be expecting, as simple as how a professional trader should trade without stress, is that I'm waiting for this guy here to create a high. When he don't do all the wahala finish for here, he's going to go up to give me a high like this. Do you understand? He needs to break this structure to the upside. You need to break this structure to the upside to give me another high. So if, let's say, price stops here now today, then in the night, price will now start coming down like this, just the way it's doing now, like this, like this, like this, like this, like this, like this. Now, before it now starts going up again, I'm expecting price to now, because if I wake up tomorrow and I see this move to the downside, price giving me this formation again, I will be waiting for us to create another high. You see the scenario here? So the question now is, without that trend line, how will I be able to identify all this point? It's as simple as that. Where price now stop, now, for me to identify this point here now, until a blue candle, a bullish candle starts printing and we break above this level. Once it break above this level, it has given me this point. Once candles start printing up now from here, that means here is the point, just like this point. Where the pullbacks end or where the retracement end, that is the point. All right, that is the point that will now push the price up. Like here, this is the last bearish candle, and here, this bullish candle, look at it, was what pushed this one up. This one too, look at it. All right, but when you now want to, as a professional trader, somebody who understands structure, you will discover that most people will say is here, but only change of character only happens here. This is the guy here, this is the POI that now broke the structure to the upside.
What's POI?
Huh?
What's POI?
Point of interest. This is what caused the break of structure to the upside. You see, when price got here, it stops, it retraces before it gathers a momentum, before it finally push to the upside. And you see this push, there was a volume, this big candle. And this is what we call FVG, fair value gap. It happens when there is large difference of price. Instead of candlestick to print price like this, like this, like this, like this. But once you see a big candle, it has created a gap. So it's not normal. At the end of the price will come back and close up. You see this point, it push back, close here. You see this one, you now see that the gap that is remaining is just in between here and here. But look at this one. He printed this one, he came back before this push. But look at what price did. Price came back at the end of the day. Look at it. It tries to close the price, the gap here. You see. See where price got to. So this one, you now see here. So if you are just looking at this candle, it's too big, but it has successfully closed the gap. But you don't know. If you don't know it, you won't know. This is it. And this is an entry. Price has come back to close up the FVG, the fair value gap. And now, before you now start pushing to the upside. So that question is very simple to identify a swing point, all right? A swing point like this, like this, like this. It's simple. Why is it simple? It's simple because after the retracement has ended, there will be a push. Because in trading, we have push, retracement. Push to the upside, retracement, push to the upside. That is a bullish scenario. A bearish scenario, push to the downside, create a retracement, that is a resistance, push to the downside, breaking structure to the downside, again a retracement, break structure to the downside, retracement, break structure to the downside. All right, so when he's doing all this, how will you now know that the trend is about to change? Normally, the sequence now is supposed to come like this, all right, to come down. But when you now see that it did something like this, all right, then it came like this, breaking this one to the upside. he has taken out this leg. They will not come. He's not supposed to come down again because he has violated this resistance. They will not stop here. Once he stop here, he will not do something like this. Or sometimes he can do something like this, before he starts going up. They will not say that this is what? Market shift. Hello? But you can still hear me. Wow. Hmm. Okay, what will happen now? Let me just pick up one more slide, then close. Then I'll send you the video so that you watch it and so that you can get the the remaining part. Yeah, it's okay. Hmm. Let me just finish the section that I'll send the video. All right, no problem. So by the time you now start seeing a move like this, for example, you now see push to the upside, down like this, then price will now break structure to the upside like this. Then you know that the trend is about to change. At this point, we'll say change of character has happened. Change of character has happened because the push to the upside has violated the resistance, which is not supposed to be. The other flows, as it's going up, is supposed to stop. It's not supposed to violate the resistance. The only level it's supposed to violate is what? Is the support level. By the time you now see a violation to the upside, just know that it's time to change your bias. But mind you, before you finally say that the trend has changed, you need to first of all understand what flipped zone is all about. Because price can break structure to the downside, it can do something like this. Price can break structure to the upside, still break structure to the downside at the same time. So before you can say that we are now on a bearish trend, from bearish to bullish trend, you have to wait for price to break structure to the upside. After giving you a change of character, you have to wait for price to break structure to the upside. Then you now know, okay, the bearish trend is now established. All right. So after a change of character, you wait for price to break structure to the upside. Then you now say, okay, the bullish trend is now established. We are now moving from a bearish trend to a bullish trend. So that is how it is. And at the same time, it can also happen from a bullish trend to a bearish trend, from a bearish trend to a bullish trend. So that is it, guys. And apart from that, we talked about the moving average. You can use moving average. We can use moving average to smooth out price action and confirm trend. By using moving average to know if the trend is bullish or bearish. How do you do that? You go to your indicator. Here is your indicator. You say moving average. Enter. All right. This is the moving average. You see Once price is trading above it, it's telling you that we are bullish. Once price is trading below it, you can see price is trading below these moving averages. You see price is below it, you know it's bearish. Once it now cross and is trading below, price is trading above it, you know that we are in a bullish market. So that is that, guys. I hope it's very, very, very clear. And apart from that, we can also use another one is using price action. Look for consistent patterns of highs and low. What does that mean by looking for a consistent pattern of highs and low? You now say, okay, price is going highs, lows, highs, lows, then another high. So you now say is what? Is see another highs, another low. Then we are expecting another highs. As simple as that, guys. I don't know why most people are still struggling. Or do you just start pursuing one candle? Once you see a bullish candle, you start pursuing it. No. Like I always tell you, it's not even the strategy that is the problem. The problem is you not knowing how to read structure. If you know how to read structure, why should you be struggling? You don't have any business. You are not supposed to be struggling if you know how to read structure. All right? If you know how to read structure, you are not even supposed to be struggling with trading. Honestly. Because push, there will have to be a retracement. This retracement, you have made profit up to this point. Do you need to still jump in and start making profit down? Some people have that time and they'll be doing that. But you have made profit, relax. Allow price to come back again to you. Then you now enter, go up. It's not all moves that you must catch. That is why, because as it's coming back, you can never tell where it will stop before it push again. The only reason why we are able to say, okay, we know where price will stop is by using our fib tool to now know the retracement point where this guy will get to before it turns. All right? You draw by putting your 100% here, 0%. All right? Now we know that every level signifies something in trading. Every level, every Fibonacci level signifies something. If you don't know what it is, go to my YouTube channel and dig that out. I have even treated that. This 23.60, this is a continuation of trend. 38.20, this one here is a reversal point. All right, this 50% from here up, all right, from this 50% up, we can now say here examples of a bullish trend is what? A premium level. Then 60% is a Fibonacci golden ratio. Once price gets here, if it passes 50%, it will hold. There will be a resistance, there will be a support here. All right? It is a golden level. And once price passes here, 79 level, all these ones are reversal point, 50% reversal point, 61% reversal point, even if it's a golden ratio, because it's very difficult for price to break below this place. Because while most traders, they have already placed their orders here. So once price gets here, if it passes 38%, 50%, but if it gets here, you will see a reaction. Most likely that price will turn from here. All right, traders will set pending orders here. All right, waiting for price to drop and get to this point. And once price cross this line, 79%, if this one did not hold, 100% should hold. If it did not hold, that means we are now in a bearish trend. If it crosses, if the body breaks 100%, that means the price, we are no longer in a bullish trend. We are now waiting for price to pull back and break structure to the upside or to the downside for us to resume a bearish trend. As simple as that. You cannot see at this point here, you see 38.20 is holding. Is holding. Is holding as a support. So most likely the price will turn from here to there. Somebody will now ask, what if it breaks below? Yes, if it breaks below, it's fine. It's even fine because now at this point, I am not even satisfied. I will not enter, even if I see price going up. Why? Because it needs to touch 50% for me to now show, okay, it has reached a discount level. Because once price goes higher, it's supposed to pull back to a discount level before it start going higher again. That is the rules. That is the rules, guys. That is the rules. So it's either it push a little down with a spike to touch this 50%. If I don't see that, I will never enter the trade. That is it. So thank you so much. And hello? 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 Good morning. What happened to your phone? What happened? What did you do? Okay, don't worry. Just give me like you are at home today, you didn't go to school. Okay, just give me like 5 minutes. I'll call you back now. Let me just close up what I'm doing. Okay. Just be with the phone. I'll call you. Yeah. Sorry, guys. My daughter just called me and I need to respond to that. Yes. So at this point, I will not get into the trade until I see a push that will touch at least 50%. That is it. But if it turns from here and there's no touch that will spike this 50%, it's going to be a little risky. That means I'm going to reduce my lot size before I get in. Yes, that is how I trade. The most important thing is for you to protect your capital while trading. So that is how it is, guys. So you use that trend line to use that moving average to uh, uh, know the direction of trend and price action too. So the price action is what we just talked about, the price action. So you look as a push, it breaks, there will be a retracement, then it will push, there will be a retracement. You are expecting a push. After that push, there will be a retracement until there is a market shift. Once there's a market shift or a change of character, then a bearish trend will now resume. So you can see what I'm saying, guys. You can see it's still threatening to come down. Yeah, it needs to come down more. Yes, it needs to come down more. So that is how it is. So on this note, we are going to stop here and we are going to stop here. Then we'll continue from here next time. So thank you so much. And don't forget to subscribe to my channel. And if you need a mentorship, one is ongoing already. All right. I'm on with my mentee, so you can as well join. All right. Here we break trading down. We break the process down. We simplify the process. Trading is difficult when you are doing something wrong. It becomes simple when you know what you are doing. All right. So we don't charge much. And our training time is flexible. We can even reason and work with your own time. All right. We schedule based on your own time. All right. The idea is for you to grab the concept. By the time you are done with the learning, then you can, sit comfortably and just be doing your thing yourself. All right. It's something you can do in the comfort of your home. And when we are having a session with you, you don't need to come to us. You stay at home. All you need, the equipment you need, is your computer and your internet. That's all. So thank you. And on this note, we say thank you. And that will be all for now.